Now, this is a tough one because just before the webinar, Eileen sent me a question via email. There were some other ones that came in today that I noticed that there were 3 or 4 questions that came in earlier via email, but they weren't registered for the webinar. We might cover those later. But in any case, Eileen sent me this question about a bull put spread on GOOG that got 12 cents in credit, and she gave me the specifics. Can you show some light on what I can do to rectify this? I'm hoping there is a solution to it. And then, of course, later, right before the webinar started, I believe she sent me an email saying that she meant this was a bear call credit spread instead of a bull put, meaning we sold the 2340, sold the 2330 call and bought the 2440. All right, and this question is going to go into John's question that he had sent via in as well, related to a similar spread position. So let's go ahead over to Power Options, see what we can do for Eileen. Then we'll take John's question. Then we've got some other questions that have come in as well. Let me pause the screen and we'll navigate over to Power Options. Okay, here we go. Fantastic. Okay. Great. Okay, so taking a look now at Power Options, of course, we're looking at the main home menu where we start on any trial account or subscriber account. And to start, I'm going to go to the Portfolio Tools where we're tracking the position as entered. Here is Eileen's original bull put spread with GOOG now at 24.10. And initially when I looked at it, I said, okay, well, you got a small net credit here of only 12 cents for this position. Right now, the liquidation is 160, but the stock is still above the put strike prices. So let's just go to the profit and loss chart here. So it's still 70 points out of the money for a bull put credit spread as she initially emailed. But again, this isn't the position that she's in. So right now, this is okay. It is a small net credit. Because the net credit is so small, I wouldn't advise managing or closing this position at this time because there's still 2 weeks to expiration, but it's still looking like it's going to expire out of the money. Don't want to take a loss necessarily until the position starts to get threatened. And as you all know, you've all heard me say many times before, what is threatened mean? Well, to me, I usually look for a 1% stop, meaning if the bull put credit spread, if I'm in a bull call debit spread that was in the money, if the stock falls to within 1% of the short put strike price, that's when I may look to manage some of these different positions. But this isn't the case. So for Eileen, real quick, let's go ahead and rebuild her structure on the fly. And we're going to have to use the calls here. And it looks like in this case, we'd sell the bear call, the 2330 call. I am assuming it's still got a 12-cent credit at 52.71. And the 2330 call and the 2340 call was bought at 52.59. So let's build that on the fly and see what we've got. So it'd be the May 14th expiration. And sorry for the scrolling, it's got a lot of strikes here. So on the bear call side, 2330, I apologize, 2330 sold, 2340 bought. Okay. So sell the 2330 call, 52.71. Buy this one, 52.59. There's our 12-cent net credit. That's our bear call spread. In this case, it looks like it's well above both strike prices. It's near the maximum loss. Unfortunately, in these situations, it's really tough to manage a spread position that's this far away. Once it goes above both strike prices, it becomes very difficult for any type of management in that case. And normal things that we would do, we're going to talk about for John in just a moment. For a debit spread strategy that had gone bad. We don't know the specifics. John, I don't really need to know the exact specifics. We can use an example there, and we'll take a look at it in that case. So, but in any case, here's a very difficult repair. Normally what we talk about, we have the 7 or 8 ways that we would manage a bull put credit spread. There's a full presentation on that. And the same thing applies to a bear call. So if the stock was threatening my short call strike price, when it started to move up to our 23.30 strike, what are some of the things we could consider doing? One, we could just close the position, take the loss, and move on. It's out of order a little bit, but two, of course, is do nothing. And if I think that the stock was bearish, but now it started to trend up, and I think it's going to recover down, we could just do nothing. Okay. The other number three is the obvious one, the first one that most people think about, of course. And three would be to simply close the whole position and move it up. Now this works, we'll call it close and roll. So we might move up to a 23.80 or some, I'm sorry, we have to go up to a 24.30, 24.40 bear call spread. So closing and rolling. But in this case, when you're near the maximum loss as it is, creating another credit spread with the same 10-point structure, we're going to accept to get more than 12 cents on that, of course, when we open this new position. But are we going to get 10 points, 988 or close to where are we looking at here, about $900 loss? We're going to get a $900 credit rolling a few strikes out of the money on a 10-point spread? No. We're either going to have to increase the number of contracts, which is drastically going to increase the margin requirement, or we're going to have to increase the strike prices, which will also increase the margin requirement to try to get back this $900 we're likely down right now. This number three is very hard to do once the stock has gone above both strike prices and you're near the maximum loss on the position. Four is also a way that we might consider closing the spread and then opening the opposite. We're wrong in the direction of the stock. It's continuing to move up and we're in a bearish strategy. So maybe I close this bear call spread, take a loss, and then look for a bull put spread following the current trend of the stock if that's how you feel the market is going to continue. So close and do the opposite. Another alternative that can be used in the 8 ways to manage a spread is not viable here. And that is normally if my short call is being threatened and if it's available, probably didn't have it available here. I think we did. I think we saw that. But what I might do is just close the short and roll it. So in other words, we get close to that 1% of our short call strike price in this scenario. What we may look to do is close the 23.30 and open the 23.35. That doesn't work in this case because it's already breached both strike prices. Okay. Number 6 might be to create a condor. So we have a bear call, and if the stock's moving up and it's being threatened, well, I might look to add a bull put to sort of bump the premium up in this case. That's not going to work in this situation again because what's killing us, what's hurting the position here, I don't want to say killing us, what's hurting the position, what's damage is done, it's already well beyond. You only use the condor management if the stock is nearing your short option strike price, hasn't breached it yet, and you think the stock might calm its current movement, stabilize, and perhaps stagnate a little bit. I don't think the pendulum adjustment would ever work in this situation. That's usually my number 8 in that case. But the pendulum adjustment in this scenario would be to potentially roll the call that was bought. In other words, here's the position. It's moved above my short call strike price. In this case, I may be able to do a pendulum adjustment where I sell to close the 23.40 and buy to open a 23.20. So with one move, I convert the bear call into a bull call debit. That only works if the loss is maybe only around 40 or 50% of the max loss expected, and it's between the strike prices. Does that pendulum adjustment work? Once it's gone this far up and with this small of a net credit, that pendulum adjustment won't work. Is there any point to try to get crafty with this, to try to create some kind of butterfly, to try to create some kind of 4 or 5 legged strategy in order to get into these, to fix this position? There's a possibility, but anytime you try to add multiple legs, adding 3 or 4 legs more onto a vertical spread, you usually end up taking potentially 3 or 4 times the risk with a small window of profitability. It's very difficult. As you know, today's material, as we discuss it here, are my thoughts based on your questions to provide information and education. These are not direct recommendations, they're suggestions. And of course, I'm not telling Eileen what to do specifically, as I'm not going to tell John what to do specifically on his given position. I'm not directly a trading advisor in that case. But what we're going to look at here is what would be our loss if we close this spread right now. That's going to give us a working point. Let's do the pendulum first. I'm going to try the pendulum, but I know it's not going to work just based on the minimum credit received and the fact we're already at a 90% loss. We would be selling our long call in this bear call credit spread to 23.40. We're going to get about $83 back. I'm going to try to roll down to the 23.20, and I can already tell it's not going to work because the debit here is equal to the difference in the strike prices. I'll explain that in a moment too. So what would we do here? We're selling to close the 23.40 call that we bought, doing the opposite transaction, and we're going to buy the 23.20. With one roll, we're going to convert our bear call credit spread into a bull call debit. We see now here our total cost is $16.48. Not quite double the $9.88 max risk we had before, but the maximum profit is a guaranteed loss of $6.48. So that didn't work. Sometimes it'll work if it's between the strike prices, where this will still be at a profit as the stock continues to go in the opposite direction. Just by seeing the numbers, I could tell that this repair wouldn't work. And if I'd use lower strike prices, it's not going to work either, just because the initial premium was low, the buyback cost is pretty high, and we're getting close to intrinsic value on most of these positions. So it's not changing too much. This is about $9 of time premium. So any strikes I go lower, there's going to be less time premium there that we're getting back, and it's just going to be trading an intrinsic. So we're not going to be able to get above this price. So let's evaluate our loss. We're going to do the opposite transaction on our custom spread tool here for both positions. This meaning we're going to sell to close the 23.40, buy to close the 23.30. Just want to get that mathematical number of where we are right now. So when I do this, it should give me a straight line profit and loss chart, loss of 803. So it's less right now than I thought it was, but it's still a loss of 803 for the potential to make 12. Why is this important? Why am I evaluating what my loss is now? Well, I would do that normally in the portfolio if I had entered it correctly, instead of entering it as a bull put, as Eileen first mentioned, and then said it was a bear call, actually, not a bull put. But I need to know what my loss is, because we saw that those other ones would work. We can't just close the short and roll it up. We can't do a pendulum adjustment in this case. Can we close it and do a bull put? Can we close it and do a bear call? Probably 2 to 3 months out in time. And you're going to have to decide, of course, what your sentiment is, Eileen, for this, whether you feel a sort of out-of-the-money bull put spread is a better approach, or an out-of-the-money bear call spread is a better approach based on your expectations for the market and for Google. But how are we going to make back $800? Well, it's not going to be a 10-point spread unless we do more contracts. Okay, we have to increase the number of contracts to try to get this value back. An $8 net credit on a 10-point spread would be an 80% return. We're not going to find those. So either we have to increase the strikes, take on higher risk just to get back the 800, or maybe hopefully a little bit more, or we have to do more contracts. So let's take a look. We know our risk now of 803, our realized loss after closing the position. Even though we're rolling, it's still realized. Let's keep it to standard expiration. Let's just go out to June. It's only 1 month further. Likely we're going to be out to September or August if we try to repair this particular position. I need a bull put or a bear call with $900. Okay? And I still want it to be out of the money on a target I feel is reasonable for the position. So let's start with a bull put. If I think Goog, and I didn't analyze this, I haven't looked at the stock chart, this is not a suggestion, but if I feel it's not going to drop below 23.30, I might start with a bull put there. But what do I need? I'm getting $44 here. So to get 900, looks like we're going to be down at 2,300. We've got to increase it to a 30-point spread. Yep, that's got to be it. It's going to be a 30-point spread in this case, I think. Oh, that at midpoint, it might not even be that, but let's take a look. So bull put here, sell the 2330, buy the 2300. That's going to be a 3,000 monetary requirement. We're getting a 1045 net credit in this case. Excellent. So now, as long as Google stays above 2330 in 49 days, it's a long time. And I don't even know, I'm assuming Google had earnings already with everyone else, but I'm going to take a look at that in a moment. But again, this would repair it in the sense that we're making up that $800 that Eileen lost. But in order to do that, we have to take on a higher risk. And this number here shows that the total monetary requirement, $3,000, the max risk is $1,955 because we keep the 1045 net credit. But that's not really the true credit we're taking on this position, is it? Remember, we have to factor in 803. So the true cost of our 2300 put in this bull put spread is going to be about 4368. Oops, sorry. Should have done that right. 4368. So now 242 net credit, 8.8% return if the stock stays above the position. And you could analyze the same thing, Eileen, with the bear call, meaning that look for bear calls that are probably going to be 20 or 30 points. If you liquidate this position now, you're going to take the full loss of, not the full loss, excuse me. We're going to realize the loss of 803. Monday, of course, the prices might be different, but you know, 800, 850, maybe $900, somewhere in that range, depending on what the market does. And then if you were stuck on repairing this position, meaning that you want to attempt to do another trade on GOOG, which didn't work out to your initial sentiment, but you want to see that $800 from the Google loss repaired with another Google spread, are you bullish or bearish? What do you think the outcome is going forward? You're going to have to go out to June. You wouldn't be able to stay in May most likely, unless you went really wide spreads. That's why I went out to June. We're looking at a 30-point spread, 3 times wider than what you had right now, Eileen, on that. And of course, you could still lose. Don't get me wrong. If something changes in the market, if there's a correction between now and June, Google could drop below 2,300, and now you're looking at a max loss of 27.58, 3 times higher than the loss you're taking right now. Almost, well, 3 times higher than the loss you're taking right now, essentially. Most repairs are going to result in a much higher potential risk on the position monetarily. Smaller return, of course, but hey, this is a potential. You might be able to find a bear call even, staying with a bear call strategy if that's what you want, doing the 2,500, maybe 2,530. That's something that you can look at later. There is not a direct management on these vertical spreads once it goes beyond both strike prices against you. There's no easy way to really repair that as there is in other situations we might look at for John in just a moment. But again, this is what you could consider. This is all I have for you here really is closing this position, looking further out to try to make it up. But you're going to have to increase the strike prices or increase that for going as well. Okay. All right. And of course, as I mentioned, we would have looked to manage that position as it got within the 1% rule to avoid taking the larger loss in this scenario. Now, Eileen, if you feel comfortable with it, if you feel comfortable with it, if you feel that the stock might not drop below a certain target price and you can find that initial $800, $900 spread to match it, but you also don't think it's going to go up above X price, you could create an iron condor to get more there as well. Okay. Stephen mentioned maybe Mike, you should tell Eileen that we should start considering married puts or married calls to have limited risk. Possibly, but I think this is just a smaller spread position, as we mentioned, with a 12-cent net credit. But yes, position size and protection is key. Before I get to John's question, which relates to this, I'm going to get to Don's question, which relates to this. As we were talking for Eileen about the repair on her credit spread, Don said, do you have a minimum percentage credit in order to place the trade? I'm assuming Don's talking about bull put credit spreads or bear calls even. Yes, Don, I do. And that's shown on my preferred, our preferred, I should say, but it's the search that I analyzed, tested, researched, did multiple criteria for. The bull put credit spread screen for the weekly bull puts, the 2-week out bull puts that we prefer. In general, I'm looking for a minimum 9% return with a 20-cent net credit. That's a base. and I usually take the top 3. Okay, so I'm looking at these. Now, volatility has been decreasing recently, and we're not seeing as many trades in here for 2 reasons. Number 1, volatility is decreasing, Don. Number 2, one thing I never want to do with a credit spread, a vertical spread, even a debit spread, maybe an out-of-the-money debit spread if I'm very speculative, but a standard high probability credit or debit spread, Don, I never enter a bull put or a bear call with earnings between now and expiration. And we're right in the thick of earnings season, so that's why there's so few results right now. What this has been doing the past couple of years, the average win ratio is about 83 to 87%. 1 year it was even at 89%. No, it was 90. It was a 90% success rate. And we've been averaging about a 15%, 14.9, and then it moved up to about 16%, 15.8% with the increased volatility over the last year. So usually the top 3 here are going to be in the you'll see 18, 17, 15. Sometimes you'll even see a 20% returned on. The minimum, though, is 20 cents and a 9.9 or 9% returned on, excuse me.